There are 4 classic patterns in VSA. 3 of them suggest a trend reversal and 1 suggests a trend continuation. This yields the best results when price is encountering a strong barrier. A low volume wide range candle stopping at a strong barrier suggests that shallow supply or demand has been consumed throughout the course of the candle, and price has now encountered a deeper liquidity pool, supposedly at the strong barrier. This indicates a possible reversal. A high volume wide range candle suggests that the dominant market player has power, so the trend is likely to continue and there is a greater chance that price will break through even a strong barrier. The other 2 reversal patterns of VSA are related to narrow range candles. Rather ambiguously, both high and low volume narrow range candles suggest a reversal at a strong barrier, but for different reasons. A low volume narrow range candle means that there is not much interest in the current side of the market, so the other market player can enter the scene with more ease. A high volume narrow range candle means that the dominant market player is aggressively attacking and the side being attacked is successfully defending the attack, creating a high action in a narrow price range. If this happens at a strong barrier, there is an indication that a reversal might take place. Velocity and volume divergence are among the most reliable trading techniques out there. A lot of traders call velocity momentum, but true market momentum is the combination of velocity and volume. I will leave that for another video since this topic deserves special attention. Velocity is nothing more than the rate of change. Indicators like the RSI, for example, measure the rate of change of price given a fixed window of calculation, usually called period. At the end of the trend, it's common to observe the standard reversal divergence signals in terms of velocity and volume. A bearish reversal divergence will occur at the end of a bullish trend and is characterized by higher highs in price action and lower highs in an oscillator like the RSI. A bullish reversal divergence will occur at the end of a bearish trend and is characterized by lower lows in price action and higher lows in the RSI. Volume divergence is also a powerful tool and it can be seen in different types of volume indicators. The most common type is volume divergence through the simple volume histogram. In an uptrend, volume divergence occurs when price creates higher highs and the histogram creates lower highs. In a downtrend, volume divergence occurs when price creates lower lows and the histogram creates lower highs. Notice the nuance here since the volume histogram only has positive values, so we only look at peaks in the histogram. Another possibility is by observing volume divergence in a cumulative volume indicator like the OBV or the cumulative delta volume, which yield pretty much the same signal. These indicators have positive and negative values since they are cumulative, so the divergent signals are exactly like the ones we find in other types of oscillators like the RSI. For bearish reversal divergence, we observe higher highs in price and lower highs in the cumulative volume indicator. For bullish reversal divergence, we observe lower lows in price and higher lows in the cumulative volume indicator. Divergent signals can also provide insight into the continuation of a trend. The heuristic for continuation divergence goes as follows. Higher lows in price in combination with lower lows in an oscillator yield a bullish continuation signal. Lower highs in price in combination with higher highs in an oscillator yield a bearish continuation signal. The combination of velocity and volume divergences happening simultaneously increases the strength of the signal. This would be a true momentum divergence. Another powerful and yet very simple way of assessing the trend is through one of the tenets of the famous Dow theory. In the theory, an uptrend is marked by successive higher highs and higher lows, and a downtrend is marked by successive lower highs and lower lows. We can spot a change in the trend when there is a change in the relationship between highs and lows. That doesn't always happen, of course, but when it does, it is clear the market has transitioned from a trend movement to a sideways movement, and that gauges the type of trade signals you should look for in the chart. In this illustration, we can observe the transition from an uptrend to a sideways market just by observing this relationship between highs and lows. In the trendy part of the movement, price is creating higher highs and higher lows. As soon as price starts to create flat highs and flat lows, we have a sideways market, which might lead to a reversal, but it also might lead to a continuation in certain cases. In this other illustration, we can see the same pattern in a downtrend. Lower highs and lower lows mark a downtrend, and as soon as price starts to display flat highs and flat lows, we have the transition to a sideways market. Once again, the point here is that this can be an indication that there is going to be a greater reversal. The important thing is to keep an eye in this relationship between market extremes. Another very famous methodology that deals with market phases and therefore market trends is the iconic Elliott wave theory. According to the theory, the market moves in patterns of 5 and 3 waves that repeat across different scales. If you can spot a trend with 5 clear waves, there is a higher chance that this trend might be near its end, or at least near a greater retracement. The Elliott wave theory is very famous, so it's one of those things subjected to the self-fulfilling prophecy effect that we can find in certain technical tools. That means that even if the Elliott wave method doesn't make scientific sense, the fact that there are tens of thousands of traders believing and acting as if these rules were true make them work to some degree, and that might be enough to help nudge price into a reversal. Since we are talking about assessing the power behind a trend, you want to observe the completion of 5 or 3 clear waves in the chart. When that happens at a strong barrier, for example, there is a slightly higher chance that the market will reverse with more power, because beyond the traders looking at the strong barrier, we will also have the help from the traders looking at the basic Elliott wave patterns. If you wish to learn more about Elliott wave theory, I have a free course here in the channel that you can check out in the card or the video description. The Wyckoff trading methodology, which you can learn in depth for free here in the channel, in the card or the link in the video description as well, is part of the big three of market phase analysis along with Dow and Elliott. Wyckoff points to manipulative patterns that happen at the very beginning or end of a trend depending on your perspective. This manipulative maneuver is created by larger traders that have enough capital power to nudge price in certain places and enough power to absorb supply or demand in certain places to steer price action in their desired direction. The movement at the end of a downtrend is called spring, and the movement at the end of an uptrend is called upthrust after distribution. If you can spot the signs of an upthrust after distribution or a spring, you will have an advantage over the traders who cannot see it. Spotting these events in combination with other tools might give you a real-time insight about the end of a trend. There are many details in the Wyckoff method in the same way that there are many rules in the Elliott wave theory. I can briefly give you the general gist of the manipulation patterns in this video though. In the spring pattern, price produces lower highs and lower lows, eventually losing strength and transitioning to a sideways market, meaning flat highs and flat lows. This suggests the creation of upper and lower limits of a range. There are many retail traders that wait for the breakout of the lower limit of the range in order to sell because they think this is a sign of continuation in the trend, which might be in some cases. However, large traders that have the capacity of absorbing supply or demand know that retail traders think in that way, so they can purposefully induce a breakout just to trigger the retail traders to the downside. This generates a deep liquidity pool. A lot of supply in this case comes from the retail traders. Large traders can then absorb the supply by entering many long positions in a narrow price range. This is what happens at the spring event. Eventually, retail traders realize that the market will not continue to the downside, so they start to reverse their positions to the upside. Meanwhile, the large traders are already in the market with a lot of long positions from the absorption. From this point, an uptrend begins. Notice that under the Wyckoff method, the large traders, which are also called well-informed traders, are always one step ahead of the retail traders, which are also called uninformed traders. In the upthrust after distribution pattern, we have the exact same paradigm, but upside down. Price produces higher highs and higher lows, eventually losing strength and transitioning to a sideways market, meaning flat highs and flat lows. This suggests the creation of upper and lower limits of a range. There are many retail traders that wait for the breakout of the upper limit of the range in order to buy because they think this is a sign of continuation in the trend, which might be in some cases. However, large traders that have the capacity of absorbing supply or demand know that retail traders think in that way, so they can purposefully induce a breakout just to trigger the retail traders to the upside. This generates a deep liquidity pool. A lot of demand in this case comes from the retail traders. Large traders can then absorb this demand by entering many short positions in a narrow price range. This is what happens in the upthrust after distribution event. Eventually, retail traders realize that the market will not continue to the upside, so they start to reverse their positions to the downside. Meanwhile, large traders are already in the market with a lot of short positions. From this point, a downtrend begins. Chart patterns receive a lot of hate sometimes due to their impressive ability of yielding late signals. However, certain chart patterns can help confirm the end of a trend with a little more clarity. For instance, seeing a double top or bottom or a triple top or bottom at the end of a larger price movement is never a bad thing. These two patterns can be used more accurately, unlike the head and shoulders or inverted head and shoulders, for example, which only have their signals confirmed when the significant reversal has already taken place. If you think about it for a moment, the appearance of a double or triple top or bottom after a strong trend matches the idea found in Dow theory. Double or triple tops or bottoms mean that highs and lows have stopped progressing in trending motion. The simple chart patterns just give another perspective in this case. You can check out a complete chart patterns course here in the channel for free as well. Along the lines of chart patterns, we also have harmonic patterns, which are a little more challenging to see for the beginner, but they can yield interesting results. Harmonic patterns take simple high and low patterns and provide a sort of roadmap for their occurrence. According to the theory, the reversals tend to be more likely when sequential market extremes respect certain vertical ratios. Certain harmonic patterns tend to occur more in the continuation of a trend, and certain harmonic patterns tend to occur more at reversals. For example, the alt bat, the butterfly, the crab, the deep crab, the shark, the AB equals CD, and the three drives can all yield interesting results at the end of a trend. Other harmonic patterns yield interesting results in terms of trend continuation. That's the case with the bat, the Gartley, the cipher, and the 5-0 patterns. I have a free harmonic patterns course here on the channel as well, in case you are interested in learning about such patterns in greater detail. The goal of this video is to show you that there are many different and valid ways to anticipate a trend reversal. Perhaps most importantly, you should understand that the best results will occur when you combine these methods together. That's because the father of all principles in technical analysis is the principle of integration. Integration is when we combine different techniques together and act at their intersection. Instead of trying to master just one of these methods, you should aim to become reasonably good in all of them, to the point where you can see and trade their intersections. That's the ideal scenario for the technical trader. That's it for this video. If you enjoyed the work I do here in this channel, please help support it by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. If you made it this far in the video, thank you very much for watching, and I hope to see you in the next videos. Take care.